Well, it's tax season again, so it's time to take a look at exactly what we should be considering in taxes in retirement. I'll give you a few do's and don'ts on this. Do use all of your different retirement and savings accounts, particularly if you have both Roth and regular traditional IRAs. Use both of them to plan your taxable income. Remember that up to 85% of your Social Security is taxed. And again, that too is income-based. It can be 50%, it can be 85%. And so planning your income using both your traditional as well as your Roth IRAs to control your income level could save you on the taxes or the amount of your Social Security income that you're going to pay taxes on. And also be aware of your total income because it will impact your investment income. Your long-term investment gains and dividends, all of those could be taxed at capital gains rates, but depending upon your income, there could be an additional tax of 3.8% called the net investment income tax. Don't just look at one account for withdrawal purposes, especially retirement accounts. Traditionally, we've been told to empty one account at a time, but the reality is mixing your income can minimize your taxes. Taking some withdrawals from both types of retirement accounts, your Roth and your regular IRA, can minimize your total taxes as well as other surcharges. Do let tax-advantaged accounts continue to grow. Withdraw from all accounts and allow those accounts, your regular IRAs, to continue to grow, but be aware of how large they're getting, because when you do finally have to start taking your RMDs out, again, you'll have less control over your taxable income because your your required minimum distributions could become quite large. Don't make moves that could put you in a higher tax bracket. Plan ahead for any large expenses that you might have. For example, home renovations or large purchases like buying a car. And use both taxable and after-tax accounts to fund these. Or straddle a tax year. Take some of your IRA distribution in one year, some of your IRA distribution in another, so that only that taxable income can be spread over two accounts. And so you can address your taxes that way. And that's looking ahead allows you to do that. Do look ahead to when you turn age 73. You'll know that you have your required minimum distributions at that time. And again, we delay taking withdrawals from our traditional IRAs, but that can be a mistake if our IRAs get large enough that our RMDs, our required minimum distributions, push us into higher tax brackets. When you look ahead and you realize that might happen at age 73, you may start taking withdrawals earlier and spreading the use of that IRA over a longer period of time. Don't overlook how long you've owned an investment. Selling investments held for 1 year or less means that you will pay ordinary income tax rates on it. So holding an investment for longer than 12 months makes both the gain tax at a long-term capital gain, which can be 0 or 15%, generally lower than your ordinary income rates. And any dividends that are paid from exchange-traded funds or mutual funds that have been held for longer than a year also will be taxed at capital gains rates. Do review your tax situation as your life changes. Major events like working past retirement, relocating to a more tax-friendly state, or dealing with healthcare costs should prompt a review of your tax situation. Always look ahead, always plan ahead. And if you need some help reviewing some of these strategies, don't hesitate to reach out. Happy tax planning.